Here's what's coming up on The Retirement Architect with David Reyes, your retirement television.
But the good part is we do use some vehicles, some principal protected annuities, things like that. If you want guarantees and want to get a reasonable 3 to 5% rate of return historically, but have principal protection, there's definitely a room for a piece of that in clients' portfolios. So there's absolutely solutions. Because you own 10 different stock mutual funds, you're not more diversified. So what happens is it gives you a false sense of security. When markets crash, mutual funds are not going to, because they're diversified, are not going to help you, right? If you own stock mutual funds, they're going to go down just like the market. Is we're going to use different asset classes like real estate, use it like guaranteed lifetime income products that will produce cash flow that we can get 4 or 5 or 6% distribution rates on, that act as a bond proxy, right? And have different attributes. Doesn't mean bonds are the devil. It just means 40% of your portfolio in bonds, when you need to take out 4 or 5% of your portfolio value and bonds are paying you 2%, you're guaranteed to run out of money on that portion of the portfolio. So the fact is, we just don't use mutual funds as a general rule in our firm because they are more expensive. So typically you can have 1%, 2%, 3%. I mean, I've seen in that range it gets high. And on $1 million, you're talking $20,000, $30,000 a year of fees that are hidden inside there, not including the fees they may be paying their advisor.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Hi, San Diego, and welcome to this week's show.
We have 30 minutes of great information just for you.
Don't go anywhere. The show starts right now. Hi, and welcome to this week's Ask the Architect, where you email your questions into us from all over San Diego, and we answer them right here on the show. David, I have some great questions this week, and I'm going to begin with William in San Diego, and he writes, David, I see gold and silver commercials all the time talking about hedging inflation. Should I add gold and or silver to my portfolio?
Well, great question. I get that question all the time, actually. And so, yeah, we're believers in that. I mean, a lot of firms will say no, but I think it's a good idea to own really physical silver. And even in our portfolios, we will own gold. Silver can be a lot more volatile. Gold's probably a better, from a portfolio perspective, if you're going to own it inside of a retirement portfolio, a lot less volatility and a good hedge. But absolutely, I think it's a missing piece in a lot of clients' portfolios. And I'm probably in the minority in that because most advisors say don't. We do in our portfolios.
So this is something that someone can come in, they don't have to call the number on the commercial,
No.
right? Come on in, see a licensed financial advisor to get the most up-to-date information, because just as you said, they can be volatile, right?
Yeah, and the question becomes, do you want to own physical gold, right? Which I think is a great idea. And also, do you want to own gold as part of your retirement investments, right?
Gotcha.
As far as your own portfolios, your retirement accounts. And I see that precious metals as an investment inside of accounts, retirement accounts, are just not as prevalent as I think they should be as far as a hedge against inflation, a hedge against volatility, a hedge against stocks and bonds. It's a different asset class. So I'm totally for that.
Gotcha. This next one is from Ann in Scripps Ranch, and she writes, I heard an advisor on the radio talk about stress testing my portfolio. What does that actually mean?
Yeah, people ask that all the time. Thanks, Ann. Yeah, that's a good question, because the reality is that most people, they don't know what that is, but also the fact is, what does that mean? Really is how much money would you lose or have you lost during stressful markets, 2008, 2000. So we stress test all of our clients' portfolios, all our prospective clients' portfolios, and basically tell you what your portfolio would do during certain market environments. And so for our clients that are conservative, they want to make sure they're not losing too much money in these stressful markets where in 2000 the market was down 50%, 2000 is down 50%. During COVID, market down 35%. Who knows what's going to happen? So when you're taking income from your portfolios, we can't have that kind of risk to our portfolios.
So I'm going to state the obvious here, forgive me, but when you say stress test, this is software that you input all the numbers into, right? And it goes back through various scenarios in history to put together this would happen if these things happen again, right?
Yeah, it's really straightforward. Basically, all you're doing is taking the investments that you currently have, and we can go back in time and look how they behaved during volatile markets. So we can actually see how they perform. So it's nice to, and most clients have no idea.
Yeah, and I think the outcome, and correct me if I'm wrong here, for some folks will be surprising in a bad way, that where they think they might be in a conservative setup or that there's only an opportunity for a small chance of it going down, they may have actually set themselves up for a large loss. Is that a fair statement?
Absolutely, 100%. Most times the client is shocked at how much risk they have. A balanced portfolio, to give you an example, of stocks and bonds during 2008 was down 35%. So people think they own half bonds, they're safe. Well, the problem is that when you have market stress, everything gets sold off. Gold, stocks, bonds. So you have to be careful about how you position those assets.
Is stress testing part of your normal, when they come in to meet you, is that part of the protocol?
Part of our review process.
It is part of the review process.
Yep.
My next question is from Marcia in Carlsbad, and she writes, I feel like our investments are all over the place, David. My husband and I are very conservative. Where can we put our money today to keep it totally safe besides the bank? Also, we'd like to have it grow a little.
Sure. Marsh, thanks for the question. Well, the reality is there's really only three assets you can invest in to protect your capital as far as guarantees go. One is U.S. Treasury bonds. Two is annuities or life insurance, and three is FDIC insured accounts. There's not a lot of choices, but the good part is we do use some vehicles, some principal protected annuities, things like that. If you want guarantees and want to get a reasonable 3 to 5% rate of return historically, but have principal protection, there's definitely a room for a piece of that in clients' portfolios. So there's absolutely solutions.
David, thank you so much. If you want more information about anything we spoke about here today, hey, pick up the phone and give us a call in the office or go to our website. And don't go anywhere. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Are you unleashing the possibilities of your assets in retirement? Hi, I'm David Reyes with Reyes Financial Architecture. As a retirement and investment advisory firm here in San Diego, we've helped countless retirees and pre-retirees create a cohesive plan to maximize their assets and, most importantly, their cash flow in retirement. Call 866-REYES-PLAN right now to schedule a complimentary second opinion review. And remember, you retire once, we retire every day.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Hi, San Diego, and welcome back to the program here on 600 AM. We're with David Reyes, who is the retirement architect and, of course, host of this show. David, great topic we have today. Fees are so important to uncover, discover, because I think in multiple conversations I've had with you, David, and of course your colleagues, that most people today don't truly understand their fee structure. They think they're paying one thing, but they could in fact be paying something a lot more, or maybe just a little bit more. So today I want to talk about that. In particular, we're going to talk about three different products today that could potentially have some large fees associated. And that first one, we know what it is. It's mutual funds. You know, it's a pretty product, but it could come with some hefty fees, right?
Yeah, absolutely. I mean, you know, one of the first things we do in our second opinions analysis is a fee assessment, and most clients, especially if all their money's in 401k plans, which have a lot of clients have 401k plans, obviously, especially before they're retired, is that's all their money is in mutual funds, because that's the only thing that 401k plans can own. That's a whole nother. You know, we can talk about that for days. Why is that the case? It's called money, right? Somebody's getting paid. So the fact is, we just don't use mutual funds as a general rule in our firm because they are more expensive. So typically you can have, 1%, 2%, 3%. I mean, I've seen in that range it gets high. And on $1 million, you're talking $20,000, $30,000 a year of fees that are hidden inside there, not including the fees they may be paying their advisor.
And not to mention if the stock market goes down. So I don't have to pay the fees, right?
Yeah, right.
When the stock market goes down?
Yeah, that's the problem. Yeah, you're paying the fees, and so it's insult to injury, especially with high fee products.
All right, the next one on here, and this is a culprit that's gotten some pretty bad press, and that's the variable annuity. Certainly lots of different annuities out there, all tools in the toolbox, but arguably, David, the variable annuity gets the bad press.
Absolutely. I mean, annuities in general get bad press. You know, we've been using them as a firm for 25 years. So they can be they're a piece of the portfolio for some clients, right? If you're completely risk averse, fixed annuities can be, because they're principal protected, can be a very good piece of the puzzle to have principal guarantees, principal protection. But variable annuities, like the name says, variable, not only do they not have principal protection, they can have market losses. They're typically a lot more expensive. So most variable annuities are just not appropriate for most clients. Too expensive, very volatile, very risky.
Yeah, and I'm going to go back, and I want to discuss mutual funds and annuities here for a moment. The fees piece that's expensive here, or potentially expensive, on the other side, you could pay very little for something quite similar and maybe no fee for it. Is that a fair statement?
Yeah, there's certain annuities, fixed index annuities, fixed annuities that have no fee. The only fee, just kind of full disclosure, would be if you surrendered the contract early. That's considered a fee. So you got to be careful when you say that.
Yes,
you know,
yes.
So I have to be careful. So yeah, if you surrender an annuity too soon within that surrender period, you'll pay a fee. When we use those as a piece of a portfolio, we're not going to surrender. We're using it for a reason.
Right.
It's a piece. It could be 5%, 10%. It could be 30%. Depends upon, it could be 50%, but we're doing it on purpose. Somebody's not just buying a product, it's doing a job.
Hey, and I want to bring this one up because this is new to my financial lexicon, David, and that's UITs, Unit Investment Trusts. First of all, what the heck is that?
Yeah, it's a gobbledygook. It's the black box. It's called the money maker for the big banks. So high fees. The fees in there can be 2, 3, 4, 5%, depends, on them. So they're a product that's created really as to create more fees. It's kind of like a mutual fund on steroids as far as from a fee perspective.
So is it a basket of stocks?
Yes, typically.
Okay.
Think of like a mutual fund.
Okay.
It just has different nuances to it, but it's a glorified mutual fund.
Okay.
But the fact is, typically it's a stock allocation, but it's just a high fee instrument it's a big revenue product for big banks.
And what other things should we be aware of in the fee world? Clearly, we've discussed 3 of them right here, but what are some of the other areas where, hey, fees could creep up on you?
Yeah, one of the things I talk to clients about, a fee is loss of capital, right?
Mm-hmm.
Think about that for a minute, right? You lose 20, 30%, that's a cost, right? So most clients don't have any type of risk mitigation as part of their portfolios, which we do as a firm. It's fundamental, is managing downside. And so that's a cost, right? So we talk about that with our clients. What's your cost? If you lost 50% and our portfolios were down 20%, whatever that is, to give you an example, that's a cost, right? So the fact is loss of capital is a cost. Taxes are a cost. So we're looking at every single area where we can, I call it unturning every rock. Is it taxes? Is it market losses? Is it fees? All those things. And when you do that, you can create pretty good plans.
Hey, David, thanks so much. Hey, if you'd like to get a complimentary second opinion, have David Reyes actually review your portfolio top to bottom, pick up that phone, give us a call right now, 866-REYES-PLAN. Visit us on our website, reyesplan.com. And don't go anywhere. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
Hi, and welcome to this week's Retirement True or False. David, I've got some great questions for San Diego this week. My first one for you, sir, is bonds and bond funds are the same thing. True or false?
That would be false. Absolutely. Yeah, I mean, that's a big misconception. I will tell you the majority of people don't own individual bonds. Very rare, probably 1 in 20 or 30 clients I ever see has individual bonds, which are better. The difference is that if you won't buy a bond, whether it's a treasury bond or which is guaranteed, which is nice, or you buy a corporate bond, at least there's a beginning and end. Right, the benefit is now what the company is, the performance of that company, the riskiness of that company is going to come into play. But with the bond fund, it's kind of like, we don't know what's in it, right? It's mystery meat, right? So the fact is that if you're going to be in bonds for a significant part of your portfolio, it's better to own individual bonds because at least we can make determinations about the company if we're going to be in corporate bonds or the types of bonds we want to own individually with treasuries, and we know kind of the end date, right? With the bond funds, you have much more risk relative to that with rising interest rates, which we're dealing with right now. Fees can be higher. There's all kinds of issues with bond funds and we use them. So it's not like they're just a convenient tool, but you just have to really know what you're doing.
So is it fair to say right now, with the possibility of interest rates continuing to increase, maybe if you have bonds in your portfolio right now, this is a good time to have a second set of eyes look to see, one, is it a bond with a maturity date? Two, is it a bond mutual fund or a bond fund? Because I think, and correct me if I'm wrong, David, if you say 1 out of 20, then there are a lot of people right now that potentially have bond funds thinking they have a bond with a maturity date. They need to talk to somebody and they need to see if that is in fact the case.
Yeah, I mean, the reality is, right now this year you've had one of the worst performances in the bond market in the history, I think since like 1973. We're talking, this is generational issue with when rates rise and you have inflation like we've had, bonds are going to be about the worst asset class to be in.
It's funny too because the connotation of bond is safety. That is the connotation, in that antiquated philosophy of 60-40, 60% stock, 40% bond. That's shaky today. Is that a fair statement?
Absolutely. We've had that opinion for the last decade. So we've dealt with that head on.
Are there people still doing it?
Yeah.
Or some derivative of that?
I would tell you that's why we call it the boomer portfolio. Almost every client sits in front of me is 60% stock, 40% bonds, bond funds and stock funds. So it's a problem. It's showing up now because of what's happening with the stock and bond market together. I was talking about the story about the pension fund that, they're trying to increase their risk by owning more hedge funds and more private equity because bonds and stocks have been going down together. And they're saying, what can we buy that goes up in value? So how we approach that as a firm, how we approached it for a decade, is we're going to use different asset classes like real estate, use it like guaranteed lifetime income products that will produce cash flow that we can get 4 or 5 or 6% distribution rates on, that act as a bond proxy, right, and have different attributes. Doesn't mean bonds are the devil. It just means 40% of your portfolio in bonds, when you need to take out 4 or 5% of your portfolio value, and bonds are paying you 2%, you're guaranteed to run out of money on that portion of the portfolio.
All right, David, my next question is, at 59.5, you can do an in-service distribution with your company 401k. True or false?
True, absolutely true. Yeah, we do a lot of those, especially when we're doing retirement planning, because the fact is, most what they've done is they've dummied down the 401k plans. There was a lot of litigation and lawsuits. Fees was a big one that was happening with plan sponsors. Also, people were invested in too risky of assets. So what they've done is they've made everything a target date fund, which means that it's going to say, 2030 retirement fund. They've done that because they want to make it simple. The problem is, guess what those things do? Every year you get older, they buy more bonds, right? So the problem is if bonds aren't good and you own a target date fund inside of your 401k plan, which most people do, all you're doing is buying more bonds every year, right? Which are getting hammered. So the fact is, that's why you want to look at ways to, maybe get out of the 401k plan to reduce fees, to have more options, to do some planning with. And so we aggressively move clients out of those type of accounts.
Yeah, and I could see how, someone who doesn't do financial services for a living would look at their statement and say, I just heard what David said, that I have more options available to me, I have potentially less fees, potentially more gains, more options, whatever it all is, but I'm scared, David. Because all I know is this is what I know. And a piece of my paycheck goes in there and they match the 2, 3, 4, 5%, whatever it is. Something bad could happen in this rollover, right?
Absolutely. So they're concerned about two things. The taxes. A lot of people think, well, if I move it from the 401k to the IRA, pay taxes. Not true. As long as you open it up with the IRA, which we do for our clients. And then number two is fees. So your internal cost is typically going to be a lot less, especially if you own individual stocks or even what's called exchange traded funds, which are kind of mutual fund 2.0. They're much less less costly in fees. They're more tax efficient. They're more liquid. So the fact is there's just so many more options, but the client has to feel comfortable to do that they're not going to have some whammy out there that they didn't realize.
You know, and this is very important. This could expedite your pathway to the retirement. Complimentary second opinion. You guys offer, it's free. Why not take advantage, sit down with David Reyes, take advantage of that 866 Reyes plan. That's what you want to call for that. Okay, last question for you, my friend. All fees are described in detail on your monthly or quarterly statements, true or false?
Yeah, that's false, big false. Yeah, that's a big problem because what happens is we do a fee analysis for every client that walks in the door as far as for our complimentary second opinion process. We do a risk assessment, a fee assessment, and a retirement income plan, all three of those. And so what we're going to do is break down if they're paying an advisory fee. We're also going to break down the internal cost of their mutual funds, which a lot of people own mutual funds. We don't use mutual funds in general as a firm because they're more costly, right? Our job as a fiduciary to our clients to reduce the internal cost. They're going to pay us fees to manage their money. We want to make sure the cost to hold those investments is as low as possible. Right? You can own stocks, and basically now it's no cost to own stocks. There's no trading fees, right? Mutual funds, you can have the same stock, and it costs you 1 or 2% to own Apple.
Is that ETF? If we do an ETF, is that what you're talking about, or is there something else for the
mutual? So you can do mutual funds are the most expensive. Then ETFs are a lot less expensive in general. And then stocks basically are no cost to own the stock anymore because there's no fees we don't charge trading fees. So you own Apple, there's zero cost to hold the stock.
Wow.
When you own it in a mutual fund, it might cost you 1 or 2% to own it in the mutual fund.
And you have the same stocks.
Exactly. It's crazy.
David, thanks so much. If you want more information about anything we spoke about here today, and more importantly, if you want that second set of eyes, that complimentary second opinion, pick up the phone right now. Give us a call, 866 Reyes Plan, or go to our website, reyesplan.com. And don't go anywhere. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Now more than ever, it's vitally important to review your current retirement plan and get an educated second opinion. Hi, I'm David Reyes, and for many retirees and pre-retirees, this is a very confusing time. As a family-owned business right here in San Diego, we have educated hundreds of families on how to retire with confidence in all market conditions. So let us help you. Give us a call at 866 Reyes Plan for a complimentary second opinion. And remember, you retire once, we retire every day.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Today I'm going to talk about, do you own the beautiful pie chart portfolio? Well, most of you do, and to know what I'm talking about, it's like, you get your brokerage statement, it has a nice little pie chart, it has all the pretty colors, right? And it looks nice, you're diversified like your advisor says. The problem is that kind of what's behind the curtain there. Part of our process when we do reviews for clients is we're going to do a risk and fee assessment. So we kind of unmask, so to speak, the portfolio. And some of the things we look for, are you properly diversified? Are your mutual funds safe? Do you have high fees? Things like this. So I call it diversification, right? As a term I came up with, I don't think I invented it, but I've used it for a long time. What's that mean? We're always talking about being diversified. Diversification to me is we own two asset classes, stocks and bonds. You can own 10,000 stocks and you're not more diversified, right? Believe it or not, if you own about 30 stocks, that's about the diversification level. So if you own 500, you just own the S&P 500, right? So because you own 10 different stock mutual funds, you're not more diversified. So what happens is it gives you a false sense of security. When markets crash, mutual funds are not going to, because they're diversified, are not going to help you, right? If you own stock mutual funds, they're going to go down just like the market. So that's one of the big things. I call it diversification. We want to use other asset classes, which we'll talk about in another segment, like real estate, other guarantee type investments, principal protected investments. Again, so diversification we don't want to have. Mutual funds. One of the things I see and hear, David, well, I own a mutual fund, so they must be safer because they have less risk because they're diversified. Wrong answer. Two problems with mutual funds. A is they have high fees. As a firm, we don't even use mutual funds for 99% of our portfolios. There's probably on one hand the amount of funds that we'll use. The reason being, there's alternatives to mutual funds, like what's called exchange-traded funds, individual stocks. In today's world, you can trade stocks with no cost, right? So imagine if I owned Apple stock inside of a mutual fund, it might cost me 1 or 2% to own that stock. I can own Apple outside of the mutual fund, it costs me 0. Right? So part of our job as a fiduciary to our clients is to reduce your internal costs. You're going to pay our firm to help manage your money in your retirement. Our job is to reduce the cost of your investments. So mutual funds can have high fees and they can have higher risk than what you think. Won't lose a lot, another concern. You'll earn good rates of return in your beautiful portfolio. So part of the problem I see is most portfolios, most of the big box retail outlets for the brokerage firms, I won't name the names, but are going to put a lot of mutual funds inside of your investment portfolios. The reason being is that they actually can get paid, it's called soft dollars, they actually get paid money from the mutual fund company, right? So that's a big conflict of interest. So the mutual funds are going to typically have you earn less rate of return because of higher fees. And a lot of times the funds that you own may are paying fees to the brokerage firm and they may not be the best funds. Okay, so we're going to bypass that, use what's called exchange traded funds, which have less fees, better taxation, more liquidity, right, and individual stocks, especially when we get into our dividend income portfolios. You're only paying a 1% fee. Most people think they're paying their advisor this fee. When we do our fee assessment, part of our second opinion review process, we're going to look at all your fees, internal and external fees. What I will tell you on average, you're paying your advisor 1%, and you own mutual funds, you're paying between 2 to 3% in total fees. Okay, that's just the math. So hope this helps. If you have any questions about anything that we've talked about today, please give me a call or go to our website. Thank you.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
Are you unleashing the possibilities of your assets in retirement? Hi, I'm David Reyes with Reyes Financial Architecture. As a retirement and investment advisory firm here in San Diego, we've helped countless retirees and pre-retirees create a cohesive plan to maximize their assets and, most importantly, their cash flow in retirement. Call 866-REYES-PLAN right now to schedule a complimentary second opinion review. And remember, you retire once, we retire every day.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Thanks so much for watching this week's show.
And if you want more information about anything we spoke about here today, hey, pick up the phone and give us a call in the office at 866-REYES-PLAN or visit our website.
And remember, you retire once, we retire every day.